How are you setting yourself up on this Monday morning?
Well, as we learned from last week, anything can happen through the course of today and next week. But what I'll say is that I think it is too early to call an all clear here and conclude that just because we were able to turn around last week, that's what's going to happen this week as well. The reason I say this, there's still plenty of risks out there, and we've really not resolved any of them. In fact, I would say there's more risks now on the table this week. And no progress has been made on the ground in Ukraine just yet. We're obviously waiting for that today. But the thing about sanctions is, first of all, they absolutely needed to be ratcheted up because they were not painful enough last week. This week, they are painful, and they are going to exert tremendous amount of pressure on the Russian economy. So that needed to happen. But I worry about the unintended consequences of things like carving out some of the banks from SWIFT and many other sanctions. For example, could there be an unintended consequence where we don't get the commodity flows that we're wanting to get, or maybe some of those commodity flows get weaponized? So I think these are all of the risks that are still on the table, not to mention cyber warfare as well. So I'm not yet saying that we have seen the low for this market. I think we need to be cautious here. So, but on this other side, Andrew, I would say if we are to make some progress in Ukraine this week, and if we are to hear a message from Fed Chair Powell on Wednesday that maybe they are paring back some of the more hawkish interest rate increases, then that could be the two catalysts that the market really needs to find a bottom here and bounce off of that. So these are ifs. At the moment, these are not givens. So for the time being, I'm sticking with a more conservative playbook.
Anastasia, what do you think we're going to hear from Jay Powell later this week? He's going to be testifying in front of Congress.
I think he has to acknowledge the fact that the geopolitical, risk has surged and the financial market conditions have tightened significantly. And also, he has to acknowledge the fact that we are starting to get to levels of commodity prices that are probably going to mean some demand destruction. So even though we are going to see higher headline inflation because of the commodity prices, this is starting to become painful for a portion of the population. So all things equal, this is going to destroy some demand. So I think he has to acknowledge that, but also speak to the other side of it, that the broader inflation pressure in the U.S. is broadening through wages and housing prices. And that's what's still going to justify the rate increases, is just not to the same tune as if we didn't have the Russia-Ukraine situation. So it's a fine balance to walk here. And I know many people are worried about the Fed putting the economy into a recession. I think he has to do his best to find a balance and prolong this recovery, because that's the best path to 2% inflation and full employment.
Shepard Smith here. Thanks for watching CNBC on YouTube.